Okay, here we are for another YouTube FAR debrief. As always, we've created this question and answer ourselves because we're not allowed to use the ICAW materials directly, but it does closely follow question setup and the answer. So I'll quickly go through the question, which you can see is quite short. The answer necessarily is pretty long, sorry for that, but we'll go through the classic bits that are tested again and again, and then stay tuned, we've got some final questions for revision at the end, just to check that you've taken away the key learning points. So starting on the left, on the 1st of January, Foldex Limited borrowed £600,000 at 5% to fund the construction of a manufacturing facility, which is a qualifying asset per the borrowing costs IAS 23. The cash received was immediately placed on deposit, so from the 1st of January, earning interest at 4%. Due to some delays, construction did not begin until a couple of months later, 1st of March 2023, when it transferred $400,000, so be careful, not all of the money, $400,000 to the construction company, and then the balance of $200K on the 1st of November 2023. So Sam at the client company has taken too simple an approach, basically credited all the interest received or receivable, so all the income in 2023, put it all into profit or loss account and debited all of the interest paid or payable into PPE, so increasing the value of the asset category there with the total amount of interest paid or payable. The loan is due to be repaid on 1st of June 2024, and we're working to 31st of December 2023 year end for this business. So that's there to tell us that the loan is a current liability because it's got to be repaid just a few months, 5 or 6 months or whatever it is, after the end of 2023. The facility was ready to use on 1st of November, but we didn't actually start using it until later. That's a very common trick that the examiners try to play, so we'll see what the right approach is there. At that date, when ready for use, estimated useful life of 10 years, Sam's charged depreciation from 1st December, so as we'll see, client accountant always picks the wrong option. It should have been from 1st November when it was ready to use, not when they actually started using it. So that's a common thing there. So all the dates are really, really important, as always, but particularly this kind of question. Into the very long answer. So you probably wouldn't be able to get through all of this in the time available, so don't worry. Just try and get in most of the key points, and I'll try and point those out to you. So under IAS 23, directly attributable borrowing costs should be capitalised and treated as part of the asset. And this is something that takes a substantial period of time to get ready. And directly attributable means the costs which could have been avoided if we didn't go ahead with this project. So since they borrowed it specifically to fund the project, here that's what the common point, the loan was taken out specifically for that purpose, then the actual interest rate of 5% on the loan should be used, and we can treat all of that borrowing as directly attributable here because we wouldn't have undertaken it unless we were doing this construction project. The loan should be included in current liabilities, as we said. Then you get into the normal three things. So incurs expenditure, and then try and illustrate that to get some marks. From 1st of March, that's when the funds were paid over to the contractor. So it incurs expenditure, incurs the borrowing costs. That was met earlier because they started the borrowing on the 1st of January. Remember, there was a bit of a construction delay, it mentioned. And it undertakes activities necessary to prepare the asset. So that's met on 1st of March when construction began. You always see these 3 bullet points, and in the brackets you always see application to the scenario using the dates that you've been given. So it needs to meet all 3 of these, not just one of them. So all 3, so it has to be the latest of the options, which is the 1st of March. So we should capitalise from that date. It should cease when all the activities are substantially complete, the asset is ready for use, which again is the 1st of November. Maybe they decided not to actually use it until a month later, but that's up to them. The standard says that we cease capitalising when the asset is ready. So borrowing costs of 20k, which is 600,000 at 5% for 8 months, should have been capitalised, but Sam has capitalised their 30,000, so 600,000 at 5%. So profit for the year is overstated by £10,000. So how do we know that Sam has capitalised the 30,000? Because it said here, all of the interest paid or payable has been put into property, plant and equipment. So if we look at the whole year, because they had it for the whole year, 1st of January, not done any time apportionment or anything clever, though, it's been too simple. So he's just taken a full year at 5%, basically, gives us the £30,000. So the next thing to think about is, why does that mean that what Sam has done means that profit for the year is overstated by £10,000? Well, if we think about it, he's capitalised everything, all of the interest costs. He's put it into the asset rather than going in a profit or loss account. But we've just said that only £20,000 should have been capitalised and going into the asset category. So the rest of it, the 10,000, should have been treated as just a normal interest expense. It's nothing special. It can't be capitalised under the rules. So it should have reduced profit for the year. It should have gone in there, that £10,000. But Sam didn't put it there. So profit for the year is too high by the 10,000 that we're talking about. Right, then we need to look at the income side. So this is again very typical. So any investment income earned before the capitalisation commences should be part of profit or loss, because it's just normal interest income. A bit like the other side of what we were talking about there with the cost side. When we're not capitalising, it's just standard profit or loss account. It goes in there. So the same principle here. Before we're doing any special IAS 23 capitalisation stuff, income goes in profit or loss, doesn't it? That's normal. So that would be the income earned in 2 months before the capitalisation starts, because remember we went from 1st of March. Okay, so they would have had the 600,000. Remember, here's a little bit of a trick, that it was immediately placed on deposit. That's not the trick, but earning interest at 4%. So when we're doing the income side, we must use the 4%. So it's the 600,000 that they borrowed. They don't need it yet. At 4%, not 5%, for just 2 months. So that's £4,000. This has already been credited to statement of profit or loss, so there's no adjustment to make. It's correct, but we need to calculate the number to get the marks there, basically. Remember, it said Sam credited all the interest received or receivable into profit or loss. The borrowing costs capitalised should be reduced by the investment income received on the invested funds during the capitalisation period, the special period, let's call it. So that's going to be income earned from 1st of March to when it's ready, so just the day before the 1st of November. So again, it's 4%, and that's going to be 200,000. So we'll go into that in a moment, for 8 months. Why is it 200,000? Because remember, on that date, they transferred 400,000 out of the savings of 600k to the construction company, so they can't earn any interest income on that 400k. It's gone, it's been paid. So that leaves 200,000, which they paid later on the 1st of November. So the 200,000 is what's remaining to them at 4% again for the 8/12ths. Because Sam has credited everything into profit or loss, that means the 5333, their profit for the year is further overstated by 5333, because the 5333 should be treated in a special way and not going into profit or loss. It reduces the amount to be capitalised. So the total interest to be capitalised is 14,667. So the 20k that we calculated above already, if you remember all the way back to there, and then we net off the income. So that's where the 533 goes. It doesn't go in profit or loss. It's netted off against the amount capitalised. So that gives a carrying amount for the asset of 614,667, which is 600,000, which is straightforward, plus this net figure that we've just calculated. So 614,667. Oh, nearly there. Did warn you, it's a long answer, but there'll be lots of marks available, and it always follows this structure and order, narrative points, and really you're just changing the figures each time. So it is worth persevering. So depreciation should be charged, as we said, when the facility was ready for use from 1st of November. It doesn't matter what choice the entity decides whether to use it or not, and that's irrelevant. So it should have been 10,245, which is the 600 plus 14,667. So I probably would have just put in the total figure there, the 614,667, rather than doing brackets and stuff. But anyway, over 10 years, but for just 2 months. Sam has charged 5,145 there, which would be the 600,000 paid. Remember, he put all the interest paid or payable against the asset category, so that is the 30k. 20 is the right number, but he did the full amount, 30k. So that's another little bit of a trick. So you need to add that in over 10 years, and he's just done it for 1 month from the 1st of December. So profit for the year is further overstated by the difference between those two figures. Correct depreciation was 10,245. He's put through 5,145. So that's a difference of 5,100. And then never forget this step. We often see, obviously, students have so much to do, get all the way through to here, but a nice easy mark here. The carrying amount there would be 604,422. You've got all the numbers that you need here. You've got the initial carrying amount. You've got the correct depreciation figure from there. But for some reason, people forget to put them together to state the final carrying amount. And that's kind of more marks just for using figures you have already. So just don't forget to do that. And then always try and total up. So overall, profit for the year is overstated by all of the different errors and differences that we found. So I won't go back through those. But yeah, total figure. This would get some follow-through marks if you made some errors earlier. Similarly, calculating the carrying amount. There'll be lots of follow-through marks at each step. So try not to worry too much. It'd be very hard to get all of this correct to the exact pound. But it's really important you get as much in of this standard structure. Even if the figures are slightly wrong, you'll still be picking up plenty of marks. Okay, so that was the question and the answer. Stay tuned. We're just going to give you a couple of questions, not on everything, don't worry, just to see if you've taken away some of the key learning points. Okay, here's our first question. So all of the money was transferred to the construction company in one go at the start of the project. Have a think about that one. So the answer is false. This would make things too simple in the calculations, as we saw. So yeah, you're normally going to find split payments and dates and funny things happening, unfortunately. Next question, the loan was a non-current liability. That's false. We were told that repayment was due on 1st of June 2024, which is 5 months after the year end of 31st of December 2023. So that's obviously within 12 months of the year end. In most of the borrowing costs questions that we've seen, you normally have this set up where it is a current liability. But obviously you need to check on the day for your exam. Okay, next question. The answer normally has 4 points in relation to the date at which the project qualified for borrowing cost treatment. We noted that these 4 points are always applied to the scenario by giving dates mentioned in the question content. So that was a bit of a trick question, sorry, it's false. There are actually 3 points every time on dates, which are always applied to the scenario. Next question, the accountant at the company made several mistakes in the calculations. So that's true. As we said, this will surely always happen or the answer is going to be too easy. So more often than not, whether it's this topic area or another, it's also the case at the advanced level as well. Anything done by the accountant already in the question wording is highly likely to be wrong, so always use skepticism. Next question, the interest rate applicable to borrowing and the investment or savings side was the same. So that's false. This would make the answer too easy, so always look out, see if the examiner is trying to trip you up with different interest rates. Next question, borrowing cost answers are quite long but very similar each time, so there will be lots of marks for a fairly standard approach. That's true, and hopefully this video is going to help you learn that approach so you can always pick up a good number of marks. Okay, don't be too sad, but I think this is the final question. So many students forget to state the final carrying amount at the year end after the correct depreciation figure has been calculated. So that's true, and that means they're dropping a nice easy mark for figures that the student may already have calculated. So really, it's throwing away that mark. Okay, that's it. Hopefully you found this video useful and you now understand how to do well in this topic area.